Good morning, everyone. Thanks for joining this morning. Judy Mayhem, and a couple more people are connecting. We're going to wait maybe a minute or so to let give people a little bit of time to join. Okay. Let's see, it's 9:02. We'll just jump right in. We have a lot of information we'd like to share this morning. Thank you all for joining. I think before we start, what we've had the habit of doing is encouraging everyone to introduce themselves with just their name and a quick 30-second overview of your professional background. So everyone can start getting to know each other a little bit before we launch into the programming. So Bert, good morning. Bert, good to see you.
Hi, here we go again.
So Bert, can I share that this is the 5th time you've participated in every fund that we've created. This is the 5th fund that we're launching. And Bert, this is your 5th year with us. So thank you so much for being here this morning.
Yeah, I thought I'd just take the 5th.
Okay, 30 seconds on your background, Bert. You can do it.
I'm longtime retired Zeotech founder, local high-tech company, and been in the town for 40 years. So I'm really like this place and would like to see it support new businesses here.
Thanks, Bert. And thanks. So good to see you again this morning. Mitch, good morning.
Good morning. My name's Mitch Emerson. This is my 2nd time doing AngelCon. Did it last year and had a bunch of fun. My professional background, I worked at Cisco Systems and Juniper Networks, started off in development and then moved into marketing and then corporate strategy. Started a software company, and now I actually just recently joined SBDC as a lead consultant. So I've been having fun with that as well.
Thank you so much. And we're super stoked that you're on the SBDC team. So thanks again for that. Yeah.
Of course, glad to do it.
So I'm going to start with, I'm the new people. I'm going to leave you for last, and just circle with, start circling with the people who've joined the fund before or participated before. Sharon, good morning. Good to see you. We're doing quick intros, names, and just 30 seconds on your background.
Hi, morning. I'm Sharon. This will be my 2nd year. Had a lot of fun last year. Met some great people. So looking forward to joining again. My background is in marketing technology. Worked in consulting for a lot of healthcare companies, and now I invest with my brothers on family assets. So looking forward to being here.
Hi, Sharon. Let's see. So Jill, good morning, Jill. So can I pre-introduce you a little bit, Jill? So every year we select a fund manager, and last year it was Donica Francich. And we also select an assistant manager. And the idea is that the person acting as the assistant manager gets a feel for what it's like to manage this fund, and then becomes the fund manager the following year. It's just a great way to, for someone to be involved for 2 years. No, I'm just kidding. And Jill was our assistant manager last year, now assistant fund manager, and will be our fund manager for Fund 5. So welcome, and thank you so much for taking on that role, Jill. We really appreciate it.
Yeah, no, I'm excited. This will be my, is it 3rd or 4th year? Maybe 3rd year. I'm investing. Yeah. So excited and see many familiar faces. So yay.
Do you want to give us a little bit of info on your background real quick?
Yes, CEO of Panzura Cloud, hybrid cloud storage and data analytics platform. I live in SLO, and the company's in the Bay Area, so go back and forth. Really familiar with raising money, and don't tell anybody, but we're closing a $100 million round right now. So,
woo!
Yeah.
Congratulations.
Yeah.
That's
female
awesome.
CEO and all the things. So.
Oh, Jill, that's super exciting. Cool.
Yeah.
Michael, great to see you again. Good morning, Michael Barrett. So,
yes.
Quick intros. Yeah.
Oh, I'm intro. My turn.
Yeah, your turn, your turn.
Hey guys, Michael Barrett. This will be my second year participating. I'm a partner at Anderson, doing tax consulting compliance for businesses in Northern California primarily. Cal Poly grad in 2007, I think. So nice to meet you guys and participate again.
Good to see you. Thanks for being with us again. Patrick Wilkinson, good morning.
Good morning. Kiki could not be here today, my other half, but my background is I currently am doing commercial real estate here, have my own firm, Archer & Company, here in SLO County. Before I did, I had a couple of restaurants and I had a moving and storage company. And yeah, so I just kind of a serial entrepreneur. My wife worked at Airbnb for a really long time and has a ton of experience on the growth side of that that business. And yeah, so this will be our second go at this.
Thanks, Patrick. And we also hired Kiki as a lead consultant at the SBDC. So this is I didn't realize that this group would be such a great group to that I would be able to talk you into doing some SBDC work for us. So that's awesome. So thank you. And so Dennis, good morning.
Good morning. My name is Dennis Schoen, and I've been in the consumer products industry for a good part of my life at this point. I founded a company called Research Nutritionals, and which we operate out of the San Ynez Valley, and we're international. I mean, we do a lot of sales overseas at this point, of course, in the U.S. But we develop and formulate specialty products and markets just to physicians. And then we do a lot of clinical research, get it peer reviewed, published, and present at medical conferences. So I'm interested in this just from the standpoint of, from an investing standpoint, and learning about that aspect of it. And I did a little bit of mentoring this summer. At the I get all the different programs you guys have. They're messed up, but whatever. The incubator program, I'm not sure what it was called.
The accelerator, the summer accelerator program.
There you go. That's what it was, accelerator. Yeah. So anyway, I'm happy to join all of you.
Good to see you, Dennis. So our new faces this morning. Mark, good morning. Thanks for joining us.
Thanks, Judy. Nice to meet you all. I guess a quick backgrounder. Most of my life in Silicon Valley, live in the startup journey of the highs and lows over about 22 years. And then the last 20 years spent most of my time in venture capital, split between Vantage Point Ventures and DBL Partners in San Francisco. Now just finishing the investing out of my own fund called 40 North Ventures, and focus mostly on industrial things, ESG related type investing. So happy to be here.
Thanks for joining the group, Mark. Mm-hmm. Nick Johnson, good morning.
Good morning. Thanks for everything. So my background is in mechanical engineering, and I'm from Cal Poly, and then a master's in financial math. I currently work at a finance company called PIMCO. I run our commodity desk here, so trade commodities like oil, et cetera, corn, things like that.
Thanks, Nick. Lynn is new to the fund here as well.
Nice to see you, and thanks for having me. I recently relocated to SLO from the Bay Area, and I've spent, decades now, mostly in the B2B SaaS world at like Microsoft, LinkedIn, and then 3 startups, and ran sales, marketing, and customer success teams. And my most recent work is in customer success, which is just a fancy way of saying how do you keep and grow your customers. So right now I work with mostly B2B growth stage companies. I work with a private equity firm as an advisor, Warburg Pincus, and I work with their portfolio companies, but then I have my own clients that I work with directly, and I work with nonprofits as well to help them grow and scale.
Thanks, Lynn. Welcome to the fund.
Thank you.
Amy. Oh.
No, I'm here.
There you are.
Hi. Hi. My name's Amy Degenkolb, and I am a biomedical engineer. I worked at Impress Technologies, now Alydia Health, which was recently acquired. I've been a consultant the last year and a half, and then I just co-founded a company, another medical device company for preterm labor. So that's what I spend most of my time doing, and coaching swimming every once in a while with Mitch.
That's great. Good to see you, Amy. And let's see, we have Matt. Hey, Matt, good morning.
Hey guys, again, Matt Walls. This is a second time joining the fund. Look forward to, I joined late last time, so I'm looking forward to seeing the full circle this time. I'm in the renewable energy business. So I spent about 4 years in San Luis Obispo as our CEO of REC Solar when it was after it was acquired by Duke Energy, which was the company I worked for at the time. Most recently, we worked for AES, another large renewable energy company, and now I'm sort of on a personal sabbatical, looking for the next thing, and so looking for this as an opportunity to sort of dig into the investment side and understand startups in that space. Thanks.
Thanks, Matt. Thanks for joining. And then we have one more person on a 1773 phone number. Donica, is that you?
No, hi, this is Kara Spence.
Oh, hi. Hi, Kara.
Hi. Sorry, I will join the Zoom a little bit later, but I had a conflict, so I wanted to call in and make sure I didn't miss anything. I'm new to this. I heard about it through Mitch. I'm from Chicago, somewhat new to San Luis Obispo. Finance professional, started my career at Deloitte Consulting, worked at several large public companies in finance, and then moved here to San Luis to work on the IPO for MindBody. And I'm currently a principal in the auditor's office for the County of SLO. So I'm curious to hear more about it, and obviously interested in the growth of SLO companies and curious about startups. So I'm excited to be here.
Thank you. Thanks for joining. We have Donica, and Donica was our fund manager last year. Good morning.
Hi, good morning. I'm Donica Forencich. I am a startup lawyer. I've been working with Judy and her team at the CIE for about 6 years. I've done a lot of the trainings for the AngelCon groups. I joined in Fund 3. I was fund manager for Fund 4, and I'm excited to continue to participate this year.
Thank you, Donica. And Donica is also going to has taken on the role of amending all our legal paperwork. So the operating agreement and the subscription agreements that we prepped our we had gotten our templates done for Fund 1, but we've been refining them over the years. And one thing that we did last year is we did have to go around and get everyone's consent for the amendment to the operating agreement to allow for the purchase of additional units to make the sidecar deal in tally form. So Donica and I talked a little bit, and when we talk about this, go through the slides, we'll maybe go about through this in more detail, but we decided to add to the operating agreement that opportunity for the sidecar deal to happen without having to go back to all the investors for signature. So hopefully that's okay with everyone. It doesn't mean we have to do a sidecar deal, but if we do want to do one, we can. So we're just making sure that option is available up front. Orion, oh my gosh, so good to see your picture. We haven't talked in a while. Good morning.
Good morning.
So Ryan, everyone introduce themselves briefly, their name, and quick sort of 30-second overview on your background. And Ryan, you were with us in Fund 1, right?
No, round 2.
Oh, 2.
Round
Okay.
2. Yep. Yeah. So my name's Orion Ross. I live in Santa Barbara right now. I work in medical sales for a corporation that covers a lot of hospitals along the coast. And I also spend really most of my working time in in real estate with different developments, some in the affordable housing area, kind of working with City College now in Santa Barbara on some projects to provide more housing. But yeah, always love people, anyways, the entrepreneurial spirit and learning about people's ideas and visions, and cool to connect with people in Santa Barbara and also in SLO.
Thanks for joining us, Orion. Really good to have you on board. So I think, and we also had Carolyn Herzog was popped in, and then we lost her. She's a financial advisor in SLO, just merged with another firm actually last year while we were doing Fund 4. And I think Carolyn participated in every fund that we've created. So this would be her 5th year. Hopefully she'll reconnect. So thank you all for being here. There's quite a few investors that couldn't make it, but they are committed, and we'll send everyone a recording of this session after the session. And then I will let Liz update us on the total numbers that we have of investors that are committed and the ones that are interested. So we'll give you an update on that. So let's start with, we did our introductions, program overview. So just as a refresher, each unit is being sold, well, the first unit for $6,000, and any additional units are $5,000 each. The extra $1,000 that is put into the fund with the purchase of the first unit helps us cover admin fees. Most importantly, it helps us cover the $800 a year annual franchise tax. And we had budgeted out that, we should be covered for at least, 10 years on admin fees, with a minimum number of 20 investors. So we have more than 20, so we should be fine with admin fees. So the maximum purchase is 2 units per investor, with an option to purchase additional units to make these sidecar deals. So this is something we can put up for discussion actually today. We had originally maxed out the purchase to 2 units. Maybe we can, Donica talked about this last week. Maybe we can open it up to, you can purchase as many units as you want, but each investor only has 1 vote, just to allow for everyone to feel as if they're participating in the process and have some voting power, if you will. There is a potential for capital call if we do run out of money for our admin fees. The max is $4,000 per investor over the 10-year period. And as mentioned earlier, it's a majority vote for all decisions. So anytime there's a strong debate about any topic that we're going to cover throughout the next 6 months, if we feel we're not making any headway, we'll just call for a vote and ask for the investors to vote as a group, and the majority vote wins. So we're doing monthly trainings as we have in the previous years. Is typically the last Friday of every month in the morning. In the past, we've done sessions that have gone from for a full 3 hours. We're gonna try and keep these to 2 hours, especially with the Zoom effect, until, once we're back in person, we can extend them a little bit, but on Zoom, 2 hours seems to be pretty much the max anyone can handle. So we'll try to stick to that format. We will send you any follow-up email after this session. We'll send you a link to recording, but also a link to apply as an investor, to provide all your updated information that we need to complete the legal documentation. Thank you. So here's the schedule. Our first speakers will provide a session October 29th. We will send you calendar invites for every single one of these sessions. So if you just accept the invite, it should be automatically populate. You don't have to keep track of all this right now. November, we will open up the application process to startups. It's going to be open for a couple months, more than a couple months. I think we kept it open until the end of January last year. So plenty of time for startups to apply. We're going to do the really get into the weeds on the financial projections and how to match up, KPIs to financial outcomes for the company. So we do a nice deep dive on that on the November 19th. December 3rd, Donica is actually going to take this one. She'll do an overview of cap tables and term sheets. We'll see if in January, typically in year 1, 2, and 3, we've provided the opportunity to go up to Palo Alto and see a RAW event, RAW, where the Sand Hill Angels group opens up their doors to allow us to, sit as observers to see how they do their super early stage filtering process and how they look at startups and the questions that they ask. It's a great, really fun evening, lots of learnings. End of January, we'll pick our top 12 and we'll launch immediately into the, and we'll talk about due diligence and how we want to do due diligence. A session in February on bridge financings. We'll look at convertible notes and safe docs. By the end of March, we'll have chosen our top 6. Oh, no, well, we'll look at the top 12 pitch live so that we can pick our top 6. And we'll start due diligence right after that. Hopefully we'll have a finalist by the end of May. So we've carved out a good 2 months for diligence to happen. And that seems that's the biggest request that we get every year. All you investors have told us that they want more time to do more due diligence. And the final event will be June 9th. So that's an overview right there. Our landing page for Fund 5 is ready. So a lot of the links and the things that you need will be on the landing page. And we will send you a link to that landing page. There's a portal portion of it that is specific to investors. And only you will have the passwords and access to the investor portal. So let's see. Yes, so we have Peter who will be joining us. He is the co-founder of Tally4, the winner of last year's event. He's going to give us an update on where the company's at. And so Fund 4 invested $145,000 in Tally4, and there was a sidecar deal. I believe it was $220,000, but I hope I'm not confusing that one with SpinShot. I think that's right, it was that. But Peter will give us an update on the entirety of the funding that occurred during AngelCon and after. And I think, Liz, correct me if I'm wrong, is Peter?
He's here. Yep.
He's here. Okay, great. Thank you.
I am here. Hi, everyone.
Peter, it's so good to see you.
How are you? I think Ben is also was going to join as well.
Oh, wonderful. So Ben and Peter are co-founders of Tally4. And Peter, you'll meet here. You'll probably recognize some investors from Fund 4. And we have quite a few new people on board as well. So I think it's going to be exciting for them also to see, well, for everyone to see where you're at and get the update from Tally4. I'll let you jump right in.
Great. Thank you very much, everyone. Yeah, it's been a crazy 4 or 5 months, however many it's been. And we've done really great progress across all fronts on Tally4. And for those of you that are not familiar, Tally4 is a web-based app for getting taxes automated. So we help move data along from transactions onto a tax form. So that's what we're doing. And what we've done since AngelCon is we have now a team of about 6. There's in addition to 2 of us. So we've used the funding to hire engineers. We have the equivalent of 3 engineers now, which is obviously very important on a SaaS product. We also have a designer, the equivalent of 1 designer, and design is very important to get everything right. But we've also spent on sales and marketing, and we went to one of the industry conferences. So we're in the CPA space, the tax professional space. So we popped our head up, I say, and went to one of the conferences and have been getting really great feedback. For those of you not familiar about the calendar for accountants, you all know them being busy in maybe March and April, but they're actually very busy also now, September and October, because there's an extension season. So they kind of push things out 6 months, and then they have to worry about it, September and October. So we're getting really great traction now. I think this week I got a prospect a day. So 7 prospects this week. And that's because the deadline just passed and they realized, hey, I've got to find a tool to help me with my data. And that's what Tally4 is. So that's really the quick update. The year is still long, and this is really the busy season for Tally4 going into the early next year.
I muted myself. Thank you, Peter. Thanks so much. I'm going to open up to Q&A because I know some of the investors that are here with us today probably haven't had a chance to check in with you one-on-one since June.
Yeah.
So just opening it up to Q&A. Anyone, just feel free to jump in.
Please do. It's good to see everyone.
Bert, go ahead.
Yeah, I'd like to hear how you closed the funding round that we were part of.
I'm trying to see who, Bert, the round that you're part of. How do the previous AngelCon? Oh, there you are, Bert. I see you.
Yeah, I'm curious about the other people that invested, and how you did with the round.
Yeah, we brought on additional investments alongside on the same terms, and they just, I guess we call them a sidecar, and they just expressed interest and just went in at the same time.
How much total did you raise?
Well, in totality, we raised 860,000 total across the whole round, which included AngelCon. So it's a good number overall. We had started before AngelCon and we got some traction first, but it's a good chunk, and that's what's been taking us to where we are today.
Thanks, Peter. Is everyone able to hear Peter okay? I'm hearing your sound fine, but I think there's a few people who are having a hard time hearing you. Michael, you're good? Okay, I'm good too. So I don't know if it's the person who's having a hard time. I think it was you, Dennis. Sorry. Okay. Any other questions? Yeah, Jill, please.
Yeah, so that funding round 860, that's awesome, by the way. How far does that get you in terms of like both revenue and time? And then when are you going to be looking to raise again?
Yes, thank you for those questions. Yeah, it doesn't get you far, right? I mean, yeah. We are really our burn rates is actually quite low, given that it's expensive to have a startup. It will last us 12 months from today, actually. So it's a good cushion. I do expect spend to go up as we build out the product. We are looking to raise in the spring. Yeah, we're looking to raise in spring, which I think is a good timeline.
Great. Thanks, Peter. Mitch?
Yeah, so good to see you again, Peter. Thanks. I was just wondering how your customer traction is going. I know it hasn't been that long, but do you see any ramp up or any growth there and what you've been doing to increase that?
Yes, it's doing very well. Let me just take a step back. One of the challenges going into being a real startup is we were still kind of provisioning accounts by one, right? So what the big lift this past quarter was it's now automated, meaning someone can go to the website and just sign up. So we're still keeping it VIP, meaning I want to talk to each customer. But as I mentioned, we're getting one prospect a day this past week. I expect that to increase. That's a really good number for the accounting space. But I think we're going to even have more as the deadlines pass. This is actually not the buying season. The buying season is November, December. So we're getting ready for much more volume in November, December, January. Let's see what other color. But we did go to the AICPI conference in Vegas. That's generated interest. We haven't really done marketing yet. We have stuff teed up for the fall in the industry sites. We have about 4 sites that we're going to be placing ads. So we think that's going to generate much more volume going into the fall, the winter and the fall.
And
do you very good. I'm very happy with the traction we are today.
Good. That sounds great. Do you have a person that's dedicated towards the marketing and sales, or is it just kind of through the team right now dispersed?
Yes, I have one person hired who's both sales and marketing very early, doing everything, kind of hitting everything that we need. We need to make assets, we need to make digital, and that in conjunction with the designers, we want to keep our brand consistent. We want our brand to be fun. As you realize, right, tax is boring. So we want to inject some of that energy, younger energy, into the fun energy, into the tax world, and we think we're doing that. And people are really excited about the product. And we got, if you go to the Zero App Store, we have 4 or 5-star reviews. So people love it.
Thank you.
Super clear. They're all 5-star reviews. We have 4 of them.
I will admit, I did give them chocolate covered espresso beans, or Ben did. That's our way of urging people to get some.
Not a bribe, not a bribe. It is urgent. Morning, everybody.
Hi, Ben. Good to see you.
Good to see you all too. Thanks for having us.
So real quick, my question to you both is for the new investors that are joining us for the first time this morning. What would you like to share about your experience going through AngelCon and where you're at today?
Yeah, it's been amazing. I mean, if I reflect back to where we were 1 year from today, it's almost unfathomable how far we've gotten. I think at that time, Ben and I were still coding demo code. I was coding the front end. I'm not even a programmer, but I learned to program to do some of the front stuff and work as a team. We had just started to fundraise. I think we started in October of last year.
Our first real customer was October.
Yeah, so exactly. Our first beta customer was brought on about this time, a little bit later than now. So in reality, we haven't gone a full year. And then, being introduced to AngelCon was awesome. I was like, oh yes, definitely. And, we definitely fit. And it was exciting. And I knew very little about fundraising myself. My brother, Ben, has been in the VC world. I'm very grateful in previous jobs and roles. But myself, I was learning on the fly. Getting the pitch down was extremely helpful, just the workshops there. And then building the network out is also very important. It's not just, hey, here's my venture, it's great. And, trust me. And, it's about articulating that, having the product and having everything in place together. And in parallel, it's a big task. And what I used to say before AngelCon and before this year is like, I said that, being a founder is lonely in the sense that you have to convince everyone of your venture. Like what's in your mind or your idea is new by definition. So everyone else is not going to understand it. Even if they want to understand it, they need to be, you have to tell them the story. You have to tell them why and how and what's the risk and what's the benefit. But when I look back and today I'm like, oh, I'm not as lonely. So, I mean, that in itself is great.
So number 1, give them all your investment money. You'll be great. Number 2, Judy, thanks for, I outsourced, some of the training for Pete. So thanks for taking the bullet on that one. So it's like you're a sister to me. Thanks. Seriously though, no, it's been great. And I think it's accelerated just like an accelerator should, where we would have been if we had naturally sort of organically discovered and gotten all the nicks and cuts that you traditionally get with a new founding team and a new CEO that's sort of trying to figure out which end is up. And my thesis is that when they throw you in the pool, is that the bubbles are all swirling around. The trick is trying to figure out which way is up by following the bubbles, except it's a tornado at first. So I think having you all to kind of point the way a little bit at least this gets a little bit closer to the surface. And I think, yes, a year ago, our sole customer is my accountant. So that didn't really count, but a year ago, we called a friend, and she was, I was just about to call you guys because I was going to tell you no, I was going to go with a competitor, the big company. And then we pitched her, and in a week, she was like, nope, you know what? Yours is better. Let's go with that. And Pete and I were like, oh my God, the dog hunts. So it's no longer a hobby, and the code is still somewhat in hobby shape. But now with real professional programmers, pulling along, it's looking a lot more professional and a lot better and self-serve. And I just saw the graphic design for the new UI by our graphic designer, UX designer, who's an old friend of mine. And it looks amazing. So I can't wait to get that in customers' hands. So thank you so much for all the help.
Maybe you guys will have to come back and do a demo next time. That'd be kind of cool. So, again, as a quick summary, what I like to share with people, is, you've turned a 3 to 4 hour process of tax filing into a, 3 to 5 minute process for these accountants, which is insane. Anyway, thank you so much for the update. And also, to your point, I don't know if everyone knows, Tally4 is in our incubator program, participating virtually from the Bay Area. So we do, they're getting lots of coaching there with our team, weekly coaching sessions and monthly sessions. So we love having you in the program, you guys. Thank you for the update.
Thank you all.
Thank you all.
Okay, we'll see you soon. Bye.
Thanks.
So we're ahead of schedule, which is great. Our next speaker is going to, I think, log in a little early, but what I wanted to suggest was maybe a quick 5-minute break. And maybe before we break, though, I wanted to just open it up for questions from anyone who's on the call right now on the materials we've covered so far. Okay, no burning questions. Great. Well, I do want to. I would love to get some feedback about whether or not limiting the number of unit purchases, just to get a feel right now of where people stand. I think we'll open it up to the entirety of the investor group next month as well. But I'd love to hear a little bit what each of you might think about that.
Just to maybe clarify for the new people, what we're saying is right now there's a max of 2 units you can buy, and then you get 2 votes or 1 vote.
1 vote. So one
vote. Yeah.
Investor.
Yeah. And you can do a side-by-side if you want, because the fund will allow it.
That's right. So post-event, if there's a lot of interest, and that the sidecar deal only, none of that money or none of those units need to be purchased now. But if we end up with a top 6 and the winner is just amazing, then we'll allow everyone to buy as many units as they want to do a sidecar deal.
Okay.
Amy.
If we're allowing for the sidecar deal, what's the difference between that and then,
Yeah, good question. Great question. So if you buy your unit now, the fund, the investors are going to choose to invest in one company, and the majority vote, that investment will go into that one startup. So all the units you're buying now are going to go into the majority vote of that one startup. The sidecar deal is optional. So there was a sidecar deal done with, you're wanting to put more of your units into the winner, but not everyone might want to do that. Maybe because now that you've seen the winner and you've got more comfort, and it's really the company that you would have wanted to invest in regardless, then you can double down. But it may be that the entirety of the pot gets voted into one of the startups that was your number 2, not your number 1. In which case, you'll be maybe relieved that you didn't buy any additional units that you wouldn't have wanted to. Does that make sense?
Yeah. And is there any downside to opening, if everyone still just gets 1 vote, is there a downside to offering more than 1 ticket, if you will? Like more than 2, I mean?
I mean, the downside is that the entirety of of those units that you've purchased will go into that winning startup. So you don't have complete control if you decide, oh, I only want to really put 2 units in that one. That was not my favorite startup.
I just meant like the limit. You were saying, should we limit it to 2 or allow more?
Right. Yes.
Is there a reason we wouldn't limit it? Or a reason we wouldn't have it unlimited?
That's right. That's right. And that's a good question. That's why I asked Donna, because I can't remember why we limited it to 2 in Fund 1. And I couldn't remember the thought process, to be honest. And so we sort of brainstormed around it. And I couldn't think of why we wouldn't open it up to an unlimited number. Donica, do you want to pitch in?
Sure. Yeah, I'm not sure why we limited it either. But you know, I think that maybe it was, you know, like we talked about a voting issue, right? Because we wanted to make sure if one investor bought 10 units, they couldn't sway the votes their way. But as we've evolved the fund, I think that because we're sort of saying each investor will have 1 vote regardless of the number of units, I think that there's not a real reason to limit it anymore. I think that way people can put in upfront the number they want to invest in the winner, regardless of who that winner is. And then we, like Judy said at the beginning, we're going to make the operating agreement a little more flexible in that the sidecar deals can be done, you know, separately on the back end once we get closer to doing the winner. And that worked out really well for Tally4 in the fact that we coupled the 145 that was the main fund with about 75 in sidecar money and just did 1 vehicle. And then there was an investor that with a large amount that invested separately directly. But and then through the other one, you know, one of the things we talked about as far as the fund evolving is for the second sidecar deal last year, those were direct investments between the company and the investors. If we make more flexibility, we can certainly have the fund do a second or third sidecar deal if people want to do that. And that would be easier for some of the investors. It's also beneficial for the companies because they have less people on the cap table if they do it that way. So that's some of the background.
That's a good point. So, and Mitch, I know you have your hand raised, but you know, we did the other sidecar deal in Spin Shot. Those investments were done one-on-one between each individual investor and the company. Mitch, do you have a question?
Actually, yeah, that was kind of my point, was that, you know, if we do allow multiple units, which I think is, you know, fine, you know, if we limit it to 1 vote per person, we do have that opportunity, kind of like we ran into last year, if we come up with 2 very close companies, to say something like, you know, okay, we'll have, you know, a certain amount invested in the first place company and then a second place runner-up prize. I think the challenge we had last year was the amount that was over. We promised 120,000 or whatever it was, and we only had 45,000 or something over. It was a small amount, and we were kind of stuck deciding, well, is that enough to really warrant a second place award? If we do have multiple people that put in 4, 5, 6 units, you know, maybe that makes it an easier decision later on. If we get to that point where we have 2 close companies, the fund could actually invest in a winner and a runner-up and have significant amounts for both. So it makes it not as tricky a decision.
Yeah, that's right. And so here's another question that maybe we want to talk about is, do we decide, you know, 150K or less, we put it all in one company? And if we raise more than that, then we can talk about divvying up the funding. You know, that's open for discussion. What do you guys think makes sense? It seemed like it didn't make sense, to your point, to put 120 in Tally4, and then we'd have 35 left for Spin Shot. 35 didn't seem like a significant enough chunk to make that investment in Spin Shot. I saw someone's hand. Jill.
Yeah, that's what I was going to say. It's in terms of the second investment, it gets a little dicey because if we don't have enough, you know, 35,000 or 50,000, it doesn't get you to a place. So it's kind of tough that way. But I do like the idea of not limiting the units and, single vote and the side-by-side stuff. Like, I think all that's great. By the way, one of the biggest reasons to do this is for the company. It makes it so easy on their cap chart. You don't have, a dozen of us individually on the cap chart where they have to get us to vote for things and do things and all of that. It's just one of us, one group, and we all come together. And so it's more appealing to the CEO of that company, which is a handy thing. So,
yeah. And so maybe, and so we need to decide. I think that's a great point, Jill. So maybe we will amend the documents to make sure we can do, as many sidecar deals as we want with as many different startups as we want. Maybe that is going to give us all maximum flexibility. I think what we need to agree on is what's the minimum amount that we're going to invest in the winning startup, so that when we do the PR, the outreach, the marketing, we need to all be on the same page. Once we put it out there, that's what we're putting into that winning company. So once maybe we have that conversation, we have to do our PR pretty soon, but maybe we have that conversation next month to finalize the number. Once all the investors are on board, we have more of our group involved in the conversation. Amy, yeah.
No, I'm really sorry. I tried to not raise my hand.
So maybe by next month we'll know which investors are involved, how much money we'll have raised in the pot. We do keep it open for a little while because people hear about what we're doing, they're excited, they want to be part of it. So we try to keep it pretty flexible, but we'll have to decide by the end of October what's the minimum amount of the investment that we want to make into the winning company, I think, just so we can do the right PR around it. Let's see, Amy, is that a real hand?
It's a real hand. I was just thinking, if we do update the operating agreement so that we can have as many sidecars as we want, then it seems like it almost makes it a moot point of how many tickets you would get early on, because it allows that flexibility to still do a separate thing. So at the end, the company, I don't know, I guess there's pros and cons to both, but it seems like if there's a really clear second place team or company, then it would allow a lot of investors to get those additional tickets for a second, they're a second place one.
Yeah.
But if there aren't a lot of, if there's just one company that rises to the top, then it seems like we don't necessarily need to have a second. So, but that's where I'm at. Right.
Yeah. No, you're right. Exactly. Yeah. Lynn.
Yeah, was last year's amount 100 or 150?
145.
145. Okay. And was that just determined by the number of people?
Yes.
And how much money they put in? Okay.
Yeah. Bert?
Yeah, I'd like to put in a vote for keeping the limit at 100 and not, last year it was even a little, for me, hard to tell whether we'd said 100 or 120. But I think 100 is a nice round number. And if we know how many extra people we have, then we can put in a solid second place, possibility, but not advertise it, because I don't think you want to do a second place if there's not a strong second place. Last year, there was a strong second place, but I think we want to hold some flexibility on that. So if you state it's 100 million, or instead of 100,000, you're going to get a lot of takers. If you say just 100,000 and you have the option to give them more, I don't think anybody will turn you down.
Mm-hmm.
So I'd vote for trying to keep some flexibility and not hem yourself in on having to do a second one, but also being able to, split out the money over the 100,000.
Okay. So we get a bit more of a buzz when the number goes up. I think last year there was a lot of buzz because we actually advertised 130,000. So it allowed us to do some PR around that, around the, about the ramp up in the dollar amount. But point well taken, Bert. We could leave it at 100. We could compromise at 120, depending on how many investors we have involved this year. But we'll put it up for a vote at our October session, end of October. And And if anyone wants to share thoughts at the start of that meeting, like, okay, I've thought about it. Here's what I suggest. Just, and this is what this is all about, right? Is having these really great conversations about why are we doing it this way? Or how do we want to do this? This is your fun. You get to decide what the rules are. Nick, question.
Yeah, and you probably may have already been planning this, but ahead of doing that vote, it would be helpful to understand what the total is. Because I hear your point about making it as large as possible. That seems very desirable. And so, yeah, just be curious to know, and also like what you expect. So, yeah.
Yeah. That's a great, we will share the data. Liz will give us an update on who's committed and how much we think we've raised. Yeah, good suggestion. Thanks. Dennis?
Just to make sure I'm understanding correctly, if we set it at 100,000, does that mean that's obviously the minimum amount that we would invest in the first place company or whatever? But again, if we all felt very strongly about it and there wasn't a strong second that looked nearly as good, and we had a total 150, we can all agree that we'll put 150 in. So it's really just the PR part of it you're talking about now. Is that right, Judy?
I think what happened last year is we advertised the entirety of the amount for the winner. And so it was felt that if we then told the winner, oh, you know what, actually, sorry, you only get 100K, and we'll put the rest in number 2 because we weren't expecting such a strong number 2. So that was the issue last year.
Right. Are you still there?
Yeah.
Okay. Yep. I thought you froze for a minute, sorry. But yeah, because I think it would be good to have as much flexibility as possible. So, we can either put more in the top one than the 100 if we want to. So, you advertise the 100 from a PR standpoint, but if we all decide, hey, yeah, we want to do more than that because we think it looks so great, then we're able to make that decision to go ahead and do it. We don't have to make that decision now. We can do it, of course, after we hear the pitches.
Yeah. Yes.
Okay.
Yeah. The operating agreement is going to be drafted in such a way that you can purchase units at any time. So if you decide you want to purchase additional units, yes, you can.
I'm just for ultimate flexibility.
Yeah. And so what we did the year before for Fund 3, and this is my last comment before we welcome our next speaker, we can advertise and do our PR and say winner wins up to this maximum amount, and that's the way we got around it for Fund 3.
Okay, wonderful. Thank you.
Yeah, Bert, go ahead.
I think it'd be better worded the minimum 100K and maybe more rather than an up to, because the up to limits your ability to do for the second one if there is a strong second one, whereas the minimum allows you flexibility to go either way.
Okay. Yeah, thanks, Bert. Okay, thank you all. So our next speaker is here, Elizabeth Jennings. Thank you so much for joining us this morning. I'm going to let you do an introduction on the venture fund that you represent and that you run, and then we'll launch straight into the presentation. Thank you so much for being with us this morning.
Thank you so much for having me, Judy, and everyone at the team. It's such a pleasure to be here. I have the opportunity to share with you this morning several of my big passions and commitments over the last few years. I want to walk you through a little bit of our perspective for context of what the angel investing world looks like. And it can take many, many forms, like the fund and the opportunity you have here with Judy and her team. It can take the form of a network, like what we work with at Swan. So I'm Elizabeth Jennings from Austin, Texas, dialing in this morning. And that network I just mentioned is the Southwest Angel Network, recently rebranded as Swan Impact Network. And if it sounds a little bit familiar, it's because we're the fastest growing social impact angel network in the United States. We are also launching a Series A venture fund and a donor advisor fund. So like I said, they can take many forms. Unfortunately, this morning, we can't get into all the nuances and exciting details and opportunities each of those present, but I will walk you through a little bit of the high-level frameworks of why this is interesting, some of the consequences of successes, of failures, what some of these terms look like in the real world, and we can hopefully just jump to some of the interesting and juicy bits about how this world plays out. So I'm going to go ahead and share my screen so we can have a few visual aids. Okay, so someone tell me if you can't see my screen, as is the Zoom world.
We can, Elizabeth, we can see your screen.
Okay,
Yeah.
excellent.
It's just not in, there we go, perfect.
Okay, I think there may have been a slight delay. Okay, so excellent. Everyone, please feel free to take screenshots or interrupt me if you have questions in the meantime. I'm hoping to go through this fairly quickly so you can get a high-level overview and then know what you'd want to dive into more later on. Okay. As I mentioned, I'm from Swan, and that is taking new forms. There's very good reasons for that because different investment network structures, fund structures have very interesting consequences in terms of the opportunities you have with different size companies with different investment structures in your own portfolios as well. So these are our smiling faces. We have a very diverse team growing out of Austin, out of Dallas. Many of our angels come from California, come from New York. We are national. We just happen to choose the middle ground of Texas so that we are equally at a disadvantage flying coast to coast. It's very convenient for us. So as a network, and I feel like this is very important context for some of my later remarks about how the investment structures play out in the real world, because Swan Impact is a social impact network first, this may affect some of your decision making if you do have impact priorities in your own life and the own portfolios you want to build. Swan is impact first, which means that when we evaluate companies, we're looking at the consequences of their actions. Some of those may follow frameworks like ESG, and some of them may very simply have been born out of necessity to create something that is profitable, but also solves a social need. So that may be in the form of healthcare. Health technology should be social impact. Clean technology, renewable energies should be social impact. They should be mindful of the type of world that they are creating and the society that they are integrating into those options. And we want to be a part of that. And that means that we're taking into more considerations around how we're shaping a market, how we're shaping the employees' lives as we go into due diligence. And that means that we also track a different portfolio of companies than you would look at if you were looking at purely small businesses, which could be an angel investment sector. We could look at purely philanthropic nonprofits. And because social impact investing can encompass all of that, we exclude the ones that we do not feel would be particularly profitable so that we can stay true to the angel investment narratives. So we are fairly young. We launched in 2016, which is really true to what you would hear about the Austin ecosystem, spreading our roots to either coast fairly quickly, having doubled our membership in the last year alone through the pandemic, which is a very exciting time to triage companies, bring in new companies, and seize new opportunities as the leverage changed between investors and entrepreneurs needing money during that time. We've invested $8.6 million so far since 2016 in 27 companies. And I'll talk a little bit more about how the fund size and the investment size may vary across the angel spectrum. That would be a very low number if you were looking at a Series A VC fund, for instance. However, it's a fairly substantial number for most angel networks in that time. So one of the interesting things that you'll notice as you have more conversations with angel investors, with those that are deeply engaged with supporting portfolio companies, is that there's really a huge dichotomy you'll find in your conversations. You'll have a few angel investors who are very passionate and have had 3 or 4 complete home runs, but that's it. And they are the outlier of the conversations that you'll have. You'll also have others who have a portfolio of 80 companies, and they may be far more successful in the long term than those who had a few lucky strikes in the very beginning. There's 2 core reasons for this. As you look at diversifying your portfolio and putting aside some percentage, 8 to 10% of your resources into this type of structure, you will find that those who do the work of the due diligence, of intelligence lead, deal flow lead sourcing, who have the expert resources to help add additionality after the fact, is a very different scenario than those who tend to go at it on their own and rely on their own organic deal flow and their own organic connections to help them source out how they can make wiser investments. Those that are hobbyists do tend to rely more on luck. And like I said, they can be fantastically lucky. But those that take this more as a profession, more seriously, such as the venture capitalists who do this for a living, do see very different results. So if you look up and you see that statistically, angel investors and even social impact angel investors may see a much, much higher rate of return than any other investment structure, it really is skewed because those that have the network advantage and the diversification advantage do see more results that completely skew the median. Now, so I underlined the word work here, and that's really the core component of why you should work with other angels, other angel networks, why working with fund structures is so important, because this is a huge skewing factor. Cooperating on an international level can have interesting legal and tax challenges. However, with a simple flip to a Delaware C Corp, the world then becomes our oyster. And so many times you may have companies coming in from either coast who have the ability to have greater capital efficiency due to the small countries they may come from that could succeed wildly in a single market like the United States that is substantial. So when you have the network advantage working with someone like Swan or through Judy's team or through other organizations and syndications, you do get very quickly a vast reach of opportunities. Now, Swan works on a quarterly funding cycle. You may or may not see this in other networks. Everyone has a different approach to managing the workload and the interest level of everyone and keeping things sustainably built inside internally as well. So we have a quarterly deal cycle, and this is usually what it runs about. We see enough companies that we find relevance within our angels. We know who is interested in what passions they may have, the other portfolio successes that we may have had that we want to replicate, and other domain expertise we have internally, and whittle this down very quickly. So initially with our companies that we see apply, there's an internal deal room that everyone has access to. They apply throughout the quarter, and we may have it immediately before we get to the initial 35, 40 companies of those that are very clearly not interesting, very clearly not social impact qualified, and so on. So we only take a certain amount seriously and put in the labor to do down selection, to invite them further into conversation with us, and to better understand, hey, is this a good use of our time? Are we really serious about this? As I mentioned earlier, these are the sectors that we focus on. If this is something that is of relevance to you, you really will want to consider diversifying your portfolio along a timeline. And I'll circle back to that momentarily, because many areas that do create for good consequences for the humans around them do tend to be longer tail investments with a completely different risk inflection across your portfolio. There are some fantastic consumer digital apps, for instance, if you want to talk about hashtag disruption, that is a different type of risk structure than saying we need a new Parkinson's device and we need to go through the FDA regulatory process. So some of this is consequential to the way you may think about your interests and how you want to spend your time, your resources, and your energy evaluating that. Like I said, we'll dive into that in just a moment. Personally, one of my biggest passions is speaking with new angel investors, those that may have been investing in other fund structures, running family offices, looking at real estate investments, and have heard that social impact investing may be interesting, but may not really have a return for them. These are the sort of people that I love, because these are the sort of people who have the most fun once they have access to the deal flow and the other angels. It's a unique personality type. And this, I don't know that everyone will tell you, but it's true. You have the fascinating people who have great depth of experience from previous lives, who are maybe serial entrepreneurs and they are reinvesting their reward from this. People who have great worldwide experience, and bringing that together creates an incredible culture of support within your investments, of deciding, hey, could this actually go this way? And it brings into a lot of conversations of how we can shape companies. So the personality types that bring together this like-minded group is really very interesting. You don't find that nearly as much in the high-pressure VC world, and you don't find that nearly as much in the philanthropic and charity world either. Angel investing is a very interesting confluence of people who share these priorities. This is the thing I want to mention several times. What's so fun about angel investing? There's a lot of personality traits that you need to have, but it's a ringside seat to the future without the responsibility of actually being an entrepreneur. So for me personally, one of the exciting things, even about the long tail investments that take longer to get through their heavy upfront risk, is it's everything you can imagine. You think about what you would have done as a child with your life if you had 17 lives to spend. Everything you found interesting, a gadget that was incredibly well designed, that solved a problem that you had been experiencing your entire life, and you saw this realized in the marketplace. It probably started as a startup, as an angel investment that was then acquired to differentiate a product portfolio in a big corporation. There are so many smart, brilliant people who are seeing fun things, clever things, interesting things that are solving real problems, and everyone needs capital to realize that. If they can have smart capital, then we can really change the world. We can change the way we look at it, even if it's incremental. It's a very exciting place to be able to influence those things, to be able to try out new products, to be able to work with new entrepreneurs, share your wisdom, help them miss some of the obstacles that you do gain from that high level view of looking at portfolios, at looking at new product lines, at looking at pitch decks over and over again. You can share that wisdom, and it becomes a very interesting sport of getting to live vicariously, of getting to try out new things, and of getting to actually shape the way people think, serial entrepreneurs will think, especially about their new products, their new companies, their new teams. And I think that's very important. It is about thinking of the future. So we do focus on SDGs and seeing what companies will create. Are they being mindful of how these companies impact each other in the marketplace while trying to focus on making a return? If you in your personal life are very passionate about several of these, that doesn't mean that you need to be part of a social impact fund, but you can certainly steer the entrepreneurs to think more mindfully about something like their manufacturing standards or their health codes or their impact in the marketplace with pricing structures. It's an interesting way to advance both your financial interests and to help leave a legacy of these things mattered because of the ripple effect that they could help create. Now, getting a little bit further into how to consider this more broadly within your current portfolio and the current resources that you have available to help create that returnable legacy. This is part of an allocation strategy. And I feel like this is extremely important to keep in mind as we talk about things like risk and the timeline you may be looking at. It is absolutely recommended that no angel invests more than 10% of their overall resources. And there's reasons for that that I'll dive into in a moment, but it is a very high risk, high reward game, offset by those two principles that I mentioned earlier. Usually we have a 3 to 10 year holding period before we can start seeing returns, before we understand really which way it needs to go. If there needs to be reinvestment, do we need to restructure the board or the team, depending on sector and market plans. Typically we see more around the 7 to 10 year period in our investments, and that works well for some people. It does not work well for others because they need a return already to continue to play. So it's very important when you think about the structure of this as just 10% of your allocation and then diversifying that within. This is a numbers game. So you will think about having perhaps 20 companies or more, and I'll explain the risk analysis on this in a moment. And we don't know which of these will fail. We know that some of them will fail. Some may fail more than others. And this is why this is so interesting. It's a numbers game like any other investment structure, except that you can continue to play, diversify your odds and help control those, unlike something like the stock market, for instance. It has that great community that has that great engagement. You can exert influence over it. And we don't know which will win, but we know how to help create those odds in our favor. So speaking of creating odds in our favor, I did just mention this is a lot of fun and that we also do work for it. So there is that balance. If you want to be engaged in companies and do work that doesn't feel like work, if you like sitting on boards and helping bring out the conversation, bring out questions, bring out underlying confluences of situations that you know need to be put on the table that perhaps less experienced entrepreneurs need to hear. If you are that sort of person, you will enjoy this greatly because that work may not feel like work, but it is extremely needed for the younger skewing entrepreneurs and startups that can be very successful. You will go through this many times as you build out that portfolio to get to that numbers game of 20 or more portfolio items. And that does mean that you have to tolerate losses. You will get a phone call, at 6 a.m. saying, hey, this CEO was in a car crash and we're in a big bind, or COVID hit and we have supply chain issues now and we need to think about triaging these companies. These things happen, particularly over time. I'll get into that in a moment, but if you're familiar with J-curve theory or the J-curve financial thinking, then you understand that most of the companies, much of the early period of your portfolio in angel investing will not look so great. And then things change. So having that long-term view and being willing to work with entrepreneurs calmly, being able to work with big personalities on your team with disparate ideas and understanding, hey, some of these things may be true in some situations, and we need to figure out if it's true for us now, rather than getting angry easily or getting frustrated with entrepreneurs. This is a very disciplined activity. And the more that you can build that community and enjoy engaging, enjoy both passively and actively helping shape these companies, the more enjoyable this really will be. And like I said, it brings out the best personalities in the angel network community. At large, you meet the most interesting people who have fantastic stories about helping to shape companies. And for me personally, I find that very fulfilling. So I mentioned earlier that there were really two big drivers in affecting the success of a diverse angel portfolio. And that was the network theory, having the internal expertise and the connections, but it is also about being able to support angels after the deal, which is another network partnership and expertise play. It means that internally, if you have a deep expertise in a particular industry, if you built your career in this, if you've been involved in a specific sector for a long time, you know the nuances, you know the pitfalls, and those can be incredibly valuable to lend to your fellow team and to lend your ear to theirs. I'll go into a little bit more about how due diligence generally works in evaluating companies, if it's seeing if it works for your network, your fellow angels, in your own portfolio. This is very important. Like I mentioned earlier, you'll see great statistics about the rate of return in angel investing, and it really is skewed towards those that cooperate and collaborate on both deal flow and on exit success. One thing that I do want to call out at this point is that over the last several years, as you can see here, the deal value for what was traditionally considered angel funding has been skewing upward closer to what we would have considered a Series A round many years ago. And so this is important because this means that we're having more leverage in the marketplace. We're also having more competition as angels because there are more angels. And this is great for rapidly developing ecosystems throughout much of the US, throughout more entrepreneurs being inspired earlier on in their lives to start something interesting. But there are many external forces that mean that we are looking for more additionality. In other words, networks and funds are getting smarter. They're getting more resources to help angels, to help the entrepreneurs to become more competitive. But it is a blossoming ecosystem here in the US across all sectors and deal sizes. Okay. I'd like to take a moment. Are there any questions? I know I'm going through this very quickly and we still have a lot to cover, but I want to make sure if anyone has any thoughts, I'd love to address them before moving on. Okay, excellent. So some of this is where it gets really interesting. So I mentioned the long tail curve. If you're thinking about you want a portfolio structure that starts returning a few 3 or 4 years, those will likely fall in different sector categories than the longer tail ones that tend to be more regulated industries, more B2B plays that have a longer sales cadence and may have a much greater potential opportunity as well, depending on what you're looking at. So I want to call out a couple of things here. This may or may not be social impact. This may or may not be any company structure. But if you have things like health tech, those can be fantastic disciplines if you have the internal capacity to understand how to help these companies succeed. It is an extremely complicated marketplace with risk that is front loaded at the time that you will be investing. Similarly, you move down the spectrum to consumer, there's less barriers to entry. You will have a quicker time to return. They may be fantastically profitable and they may be fantastic social impact companies as well. So it really is a broad spectrum. These are 3 that we see come through the SWAN impact pipeline. Personally, I have more of an interest in the health tech side, and we're about 40-50% health tech, 60-50% clean tech, and a smattering of a few that actually cross the line there as bioproducts. And that means that our network tends to draw angels that are looking for that 7 to 10 year return, that are willing to carry that upfront risk of regulatory, of clinical trials, of early stage market adaptation to their models of how they go forth to actually enter the market. And that's not for everyone, which is one reason why you have syndicates where you can help fill different rounds, where you can send deals to other groups of investors who have different priorities and different portfolio structures. So typically you'll find angels in this space, and I have several of these highlighted here for a reason. Friends and families, the tens of thousands, and you have up to really 500,000 where you start looking at different term sheet structures for the majority of these deals. And as I said, this has been skewing upward. Many times, if you're looking at health tech deals or clean tech deals, you're looking at non-dilutive grants from the NIH or NSF, and there's a heavy burden to help uplift that funding gap for these long-term investments in the science community with those grants. So typically, you'll have angels who have connections to grant writing and who help use that as a source of validation for deal flow for the companies that want to be invested. The same thing for friends and family. It's very important to understand what terms they went on early on before they had any validation. It was just an idea in a garage. So typically you're thinking about the pre-seed seed size. And again, this varies greatly by sector. If you're looking at a medical device or a diagnostic, for instance, you may need to add another 0 between that, what that seed round looks like versus something that is a consumer good, depending on their manufacturing costs. But in general, when you're evaluating new opportunities within your deal flow, within the companies you may see as particularly interesting, it's important to know how your options will be in the future. So usually you're coming in this stage, and usually you're looking for revenue-based funding, or your decisions on your term sheet will be based on their forecasts and how they plan to execute based on those numbers. Now, this is very complicated because there are so many nuances of the consequences that may happen down the road, but you're at this interesting space where there's validation that can be replicated theoretically in the market, in their product. They have an MVP, they have some framework, and now we're at that place where we can decide based on this data, do we want this kind of term sheet? Do we really want to focus on the validity of their forecast, or is that still too far out because this is a longer tail investment? You have many different ways of evaluating this. There's many different frameworks. And again, if you are new at this, this is a great way to get involved, to lend the experience and take advantage, your experience, and to take advantage of others who may have more precedence around how these term sheets may play out for those specific types of companies. Generally speaking, the entrepreneur will have an idea of what they want, and there's always room to negotiate as you move forward. I'm going to dive into a couple of these pretty quickly to give you an idea of what this may look like in the real world. So a key concept, I'm sure you're familiar with valuations in many different contexts, but essentially in angel investing particularly, we're looking at a pre-money company valuation plus the investment amount, and that should be the post-money company valuation. So this is why we have third-party agencies bringing in their own resources to go through governance and due diligence of their own to create a valuation that everyone can agree upon. It is fairly risky to believe the company themselves if they haven't had a third-party valuation done, but generally speaking, this is the equation that you will look at to know what the valuation is. You'll see other networks as you move through their P&L. It may be a lot of zeros at this stage. It may be a lot of 50,000, maybe 5 million after 5 years. And you'll be wondering where they came up with their numbers. This is a great way to start and then work backwards around what they believe their adoption, their cadence will be like, their operating costs. We'll go more into that in the due diligence, but due diligence section in a moment. But at any rate, when you start at the valuation, you can work backwards pretty quickly to see, hey, does their claims hold water, or does this seem a little bit shaky? In terms of term sheet, and I know I'm starting at the high level here. The reason for that is if you do get a company that says, hey, we're valued at $100 million, but they have no revenue and no real proof of concept, you know, okay, these investors who have already, their friends and family may not have really done their due diligence. We're really not sure about this. And you can get a good litmus test of the way the company will make decisions in the future. Well, those are certainly not something that you're going to see here, but it's important to know how they're asking something in the context of what it's going to imply for your portfolio. So this is a very important chart. Essentially what we have here is at the top, these are debt term sheets. These are debt structures. And at the bottom, we move through hybrid vehicles towards equity. So with the convertible notes, I'll dive into this a little bit more in a moment, but a convertible note is essentially a debt vehicle that allows you to purchase equity upon a predetermined date or event. With this depends largely on, like I said, on basically every component of the company and what they are planning to happen, what their advantages in the market, their timeline, and if they're looking to exit earlier, exit later. Some things to note here, the debt is obviously much safer for investors. Debt is always repaid before equity upon events. Now, Keep It Simple Securities, KISS, was invented by an accelerator called 500 Startups. SAFE notes were invented by Y Combinator. And they have different pros and cons, different variations based on what the startups and the investors would like later on. The most important thing here, and again, this really has a lot to do with what you perceive the risk to be and what your analysts perceive the risk to be and the opportunity. Around, do you need the additional clauses? So the more investor friendly ones, debt is very simple. Debt has more clauses to bring back your terms, your ability to pull out, your ability to call the debt, and so on and so forth. But the real important part is the MFN, the most favored nations. So the most favored nation clause really helps you upon later rounds, which could go all the way through in earlier time series Fs, making sure that you can convert at the best or lowest price for you and move forward to help restructure your portfolio as needed. So I'm going to walk you through convertible debt as a mechanism very quickly. It is what you would be more likely to see below the 500,000 mark, largely because there are heavy upfront legal costs to issue preferred stock. So if you're looking just at debt, we do not need a valuation. We can just convert that debt upon that event. So generally you have startups below the 500,000 raise mark who will look at convertible debt simply for its ease and for the benefit of those high risk upfront investors who are willing to take the leap. It's also important because many times if you're looking at the like safe notes, for instance, there is already enough traction when you already have a lead investor who has written a term sheet, who has the additional clauses such as most favored nation in there, who can say, hey, we've done our due diligence, we're going to share a deal memo with you, and we believe that it's worth the risk to get these terms at all. In convertible debt, like I said, you typically have a company that does not want to worry about their valuation at the moment. They want to get through the most important upfront issues that they need to have any reliable valuation at all. It does move forward quicker, and it does convert at the term that you define. So a couple of key terms here to make this make sense. Your interest rates, typically 3 to 8%. It could be annually. Typically, this is called within 12 months to 24 months. This is a pretty short phase. Sometimes you have convertible debt that moves quickly, then into a bridge round, or then into your Series A. And the company may be fundraising pretty quickly. And this is simply their initial vehicle to get started. The discount rate could be really anything based on sector, but 20% is typically what you would expect. Valuation cap is very important, and you would see this standardized across the term sheet for all future investments with convertible debt. And it really is something that you will want to look at as you go through the due diligence with your team, because that cap can be very important on what your options are later in the future and what your conversion rate looks like. Conversion triggers, typically Series A, depending on the sector that you're looking at. You may be looking at 2 or 3 or 4 rounds prior to an exit or acquisition of different varieties. Maturity dates when it's repaid. Okay, so going back to the valuation cap being very important on what your options are and what this looks like, this is typically what we see. There are so many different factors based on everything to do with the company's operations and market dynamics that this can play out in many different ways. But this is typically what you would expect in terms of the effects from their revenue to their valuation. Okay, so now we're going to go through just a little bit of math, but not too quickly. So we've spoken a little bit about valuation, very simple multiplication there. Now we have dilution. So this is the future rounds. I mentioned grants are non-dilutive. Obviously, anyone else who's coming in on a cap table will see dilution. Now in this example, if you walk through here mentally, you can see the progression of the return because every new additional round is an up round. And so you can see fairly easily here, your multiple on investment comes nearly up to 7. Unfortunately, we've been in a situation where this is what more or less occurred. This, of course, does affect, they went through 4 different rounds, and then they were acquired after this. This is a fantastic progression. We always want to see this. We do not always see this because every company moves differently, especially with their valuation. This is the other direction in which we, did not get the return that we had really hoped. So this is a struggling environment. They went through the same amount of rounds. They were in the same industry, but unfortunately, as you can see, these numbers progress through each round. They did experience a down round. And if you're thinking about highly volatile marketplaces where you may really believe in the founders, you may really believe in the products or their services combined with their products, and you want to be protected against a down round, then you may want to look at structures that are more in favor of investors that offer less flexibility for the founders, such as convertible notes. Okay, so this is getting out of the math. And again, please feel free to ask questions. We do have a series of 5 fairly intensive webinars that are free and open to you if you would like to join. There's a link at the end of this presentation that walk you through more case studies of how these play out, of how Best practices have been developed over the last 20 years to adapt to current marketplace issues with different sectors as you evaluate these. It's a lot of fun to really get into, but maybe not at the moment. Okay, so as you look through different terms, different opportunities, the different risks for those, the important thing is to think about diversification. So I mentioned earlier the number 20. 20 tends to be the magical number here, and it is because of the ability to offset that number line of portfolio companies. Now, of course, this does vary again by sector and by your timeline. You don't want to put too much in one area unless that is something that you feel that you or your team or your fund or your network can particularly influence. In terms of how big a portfolio you should see, this is very important. So this is built off of multiple academic studies of your rate of return. This is how you get to those extraordinary numbers that you will hear cited about your rate of return in building your portfolio. The more you have, the more likely you are to have one company that takes up the space of 20 others, and so on and so forth. Again, this does vary by industry, but statistically speaking, this is a fantastic way to mentally frame how many times you need to make an investment to actually see that return. And remember, everything is time, money, and risk. So then you'll ask, okay, so you've mentioned that we need to think in terms of maybe even up to 10 years, between 3 and 10, number 7 tends to be magical here. This is why. So we're looking at which companies will fail fast, we'll get our debt back, we'll get our initial stock back, and then what happens? So we want to get rid of those very quickly so we can continue to allocate resources accordingly. This, I can send you some additional reading that will illuminate if you have a particular sector focus, but this is typically what you see. This is the influence of that J curve I mentioned earlier, where you may see your portfolio underwater for 4 years, 5 years, and then it will start to tick up. And that's because the companies that are going to go out of business, they fail. Hopefully they fail quickly. The companies that take some more momentum to get going, that have a truly novel product, tend to have a more upfront investment required to build their market, to create that market adoption, to become competitive in changing the dynamics of their industry. And so you do see this curve pick back up. What goes down usually comes first. That is important in this mindset. I mentioned earlier the disposition of being willing to see companies fail, entrepreneurs that you believed in. The important thing is that usually they come back and they're better the second time. So then the question, do we need to invest a lot? Does that matter? Does it matter between 100 grand, 150 grand, 200K? What is our statistical likelihood of actually having a return based on that? Really, we see no large statistical difference based on that. So you could put in 20K and your likelihood of having a return is not necessarily influenced. This is very company structured impacted. So if you have a company that does have a large operational burden in the beginning, such as a company that needs to go through clinical trials, then making sure that they can collectively use that capital in an efficient manner is much more important than knowing that you have put in between 20 and 50K. If they cannot make up that difference and they cannot move in an efficient manner, adding more money to that will not make any difference in terms of your potential likelihood of return. So I'm thinking about how much to invest in total of as a percent of all of your assets in this asset class. It does skew more between 10 and 20. And like I said, statistically, your odds of having a magnificent success, bringing everything up above water in your portfolio sooner does hit after the 20 mark. Some angel investors will move all the way to 80 or to 100, particularly if they are prolific in a particular sector. Oh, and this is very important. As you're thinking about this, it is likely that you will have a board seat or you will have other investors that are in your community on the board advising them. You will receive updates from them. They will have obligations to report back to you, and you may want to be part of the follow-on round. So it's important if you do have particularly interesting companies to bookmark resources for supporting them in the follow-on rounds. Okay, so our rate of return, going through due diligence, the single biggest factor why working with an organization on this is so important. Due diligence payoff. I've got to tell you, internally, this is a great administrative effort. It has to be high quality. You have to find domain experts. You have to codify this process as you would with any other business operations. On the angel world, this is very interesting because we're all here to do good with our resources and to have fun with it. And due diligence starts to look a little bit more like actual work. You need to do market research. You need to understand the adoption cadences, the cost of operations, all the way through to governance. If you are in social impact, then you want to evaluate those. If you believe that the jockey may be more important than the horse in this company, you may dive even further into the team and to understanding how that team interacts with their potential customers. This can be a big process, but it matters so very much. We will see investors time and time again who understand that through our due diligence, we may see these are these 3 red flags, but you know what? We know the partner who can offset these 3 red flags. If we can get them a letter of interest, if we can put them in front of a potential distributor, acquirer, whoever that critical business element may be, we know we can help mitigate that. And this is where the additionality comes in because we can help influence their pivot points. That's what you find out through these conversations. If you do want to get into angel investing on your own, you can certainly do that work yourself. You will build your own internal process. It will become tiring, certainly. Having a lot of individual conversations for us with Swan, each deal we go through and write an original deal memo for requires 7 to 20 people. We have mentors, we have learners who perhaps are younger or is not as familiar with going through the process. We have a codified framework to help reduce biases and weight more important facets based on our experience. And it has been a tremendous effort. But between those 7 and 20 people, we may still spend upwards of 40 to 60 hours on every single deal. And as a result, we create less work for ourselves later on. And our deal memos are more likely to be syndicated by our partners and shared as well. So there is a huge benefit to putting in this work and to learning on the work from others. Oftentimes we'll receive deal memos created by another team on their previous round. And this is fantastic. Everyone loves to see, hey, we completely agree with these risks. Did the startup address those risks? Did the startup take advantage of those opportunities? Those shared perceptions are incredibly useful. And that's really where you get to the interesting points of the conversation around your own experience, your own network connections, your own industry deep dives, and the way you can create something together that adds that additionality of, hey, we can help make this company better than anyone else could. This is really the process. As I mentioned earlier, typically you have applicants that then get rapidly down selected based on very obvious criteria. We can remove usually about half of those up front. Then we create a team around the structure we have. 9 chapters go into a document that does become the deal memo. And to be very honest with you, it's an executive summary that's about this long that says the key objective principles around why this company may succeed, their key risks around why they may fail. It is not an advice or an opinion. It is simply what information has been gathered. And then we all go to lunch, we have conversations, and it's that short executive summary where you see this guy knows about clean tech, this guy knows about health tech, this woman knows this team from another angel network or another previous fund. And you can really build that conversation off of, you know what, I think this would be really interesting if, or I'm really concerned this team is so young and they haven't really understood how to work in complicated regulated industries, or they really haven't been validated yet. Because of those conversations, then you can help decide whether you personally want to invest, whether you want to wait and see, and perhaps keep in touch with the community. Most of the time, once you get to a deal memo, we personally go through with it because we have those 2 prior steps and commit so much time to it. Okay, so story time. We've been through 27 companies so far, and this last quarter, we went through 6 or 7 to go through and finance 3. So that last time wasn't sure, and we have many great red flags that we will see on the horizon, such as the responsiveness of the entrepreneur, their ability to be trainable, particularly if they are on the younger side. These are 2 of our successes. So I'm going to start off here. As I mentioned, our portfolio is somewhere around the 50-50 mark, between 40 and 60%, depending on how you calculate value versus number, between health tech and clean tech. And so those are longer term investments. We're looking for 7 to 10 years, and these completely beat that. So what you have here are some commonalities. These 2 entrepreneurs had technologies that were novel in the marketplace. So that meant that the play was more about disrupting, removing other processes, and overcoming the change management within their clientele. We're talking large corporations, or we're talking about selling to government entities and public entities that interface with the government. So these are long tail investments that had higher upfront risk with a novel technology that may or may not be adopted in the marketplace, and requirements for slow cadence partners. So we would consider these wildly challenging, honestly. It is less linear, the permutations that could happen as they go to market, than something that would be a direct-to-consumer good, for instance. However, the commonalities of their work ethic, of really betting on the jockey rather than the horse here, helped. But internally, we also had a great team of previous entrepreneurs who knew about this space, who knew about renewable energies, knew the correct partners to help them get engaged with. And that really did help move them forward in the deals that led their ability to get follow-on funding that did lead to their eventual acquisition, or in Curb's case, merger. So these have been great successes because of our ability to mitigate those risks through our known contacts, through our resources internally. Health tech plays out in a different way. So again, this is my personal passion because it helps change lives, because it helps us all have higher quality of life. And so we can do good that is more tangible. We can help patients. We can help ourselves and our own family members. And because it is incredibly profitable as well. Harmonic Bionics is one of those case studies that I'm looking through very quickly, because so far it has been a great success. We do see them coming up on that J curve of building more revenue. But for the longest time, it was a team of university spin out, which meant that they had day jobs and they had IP they were going to have to work with in the university, to work through offices of technology commercialization. It's really dependent on their team. If you have fantastic university innovation centers, they know how to run that. If you have professors, for instance, who are not putting their fire to the feet on this, it can take a long time. It really varies. And so if you find a quality organization, it is very important. In Harmonic Bionics instance, we had 2 entrepreneurs who had developed this technology as part of their research as assistant professors, and could not for the life of them give us a solid pitch. We worked with them for 2 or 3 years because they kept coming back and they kept applying. We kept supplying them with feedback on, you guys don't understand business. You have no idea how to enter the market here. You need someone who has the business side to them. You need to be CTOs. You need to run the technical development, the R&D of these machines. So what you see here are highly regulated robots in which a patient who has had a stroke will put their arm in, for instance, and go through the motions of rehabilitating them with greater consistency and longer term therapy at home, for instance, than they would be able to receive in a clinic with a trained provider. So this is very, very risky, because if the robot does anything wrong, you have a patient inside of it, a patient who has already been injured. Even validating that took a long time. However, they brought in a new CEO. So Chris Prentice completely turned the company around, and we would not move forward until we had a CEO we could believe in, because we knew we have some great technical guys, but they cannot create a business out of this. And you will see that as you evaluate these companies, you get to that point and say, oh, I really like this person, but this is not their strong suit. This is not the rodeo they need to be in. They're going to turn this into a circus. We need to find someone else who can help shape this. It's not often, but it does happen. And you do want to have those conversations flagged among yourselves around what you think that may look like, so that you can be prepared to execute that pretty quickly, rather than later on in a dark and stormy night when perhaps the team is feuding or making poor decisions and more executive action from the board has to be taken. Stage 5 is another success that we've had. This is a device that sits in the inner ear, like a Bluetooth gadget, that helps patients who have Parkinson's have stabilized inner ear and thus be able to hear and speak simultaneously without the dissonance that prevents them from being able to communicate effectively. And the reason why I chose this one, it has been moving up the J curve. We had revenue, they had great traction. They just needed operating capital from us, which meant that we were able to go on terms that favored them more, because we believe the risk was much lower. And so far that has proved to be the case. The reason why I pull this out for you is to share with you a little bit more of what it feels like to go through the due diligence. Now, I work with VCs, I work with private equity, with family offices. I'm looking at health tech deals every day through Swan, and I come into a meeting doing due diligence with some of their customers, their early customers, just with my business voice on, aggressive. I have my notes out. I'm ready to make good use of this time. Let's see if this is a good deal. This is a riskier term sheet, like I said. And then all of a sudden I'm hit with that I'm speaking with patients. And it took me a moment to snap my neck back into place and say, of course, these are humans. And I'm speaking with people who have severe Parkinson's, and they can hear me and they can speak back. And listening to the stories of how this device had changed relationships between couples, because they could communicate again calmly around how they interacted with their communities. They could go to golf and complain together. They could go out and have drinks at restaurants together again, because they could be heard. They could be part of the community. It was so impactful. And so many times with these companies, it's easy to look at the portfolio structure. It's easy to dive into the nuances of negotiating terms, debt vehicles, and maturity dates. But at the end of the day, one of the most fascinating parts about being an angel is getting to play with companies, is getting to interact with the patients, the customers, the government entities. It's working with accelerators, incubators, very smart young people, very smart, wise people who have been through things that you read in the news 20 years ago and had no idea who was behind. You do get to interface with the interesting, objective, quantitative world, figuring out how to diversify your portfolio and how to offset your costs. But you do also have that ability to interact with incredible entrepreneurs and incredible angels and help make a difference. However you feel that that difference ought to be made. It's, like I said, the most fun thing as you think about living vicariously through others, as you think about exploring other options, other opportunities in your life. Some of these companies, like I said, may work internationally, and that means you get to go on the ground floor of helping new emergency medical record systems be deployed in developing countries. You may get to try out new food science products that are changing the waste industry in Southern California. And so this is very fun, it's interesting, and it, for me, fulfills different aspects of my intellectual curiosity, my need for community, and the way that I think about planning my financial life and the way that I spend my time personally. This is the fun of entrepreneurship without the responsibility. because you can check up on the entrepreneurs and see, hey, have you done your homework? How is this going? I would love to know about this deal you're brokering. I'd love to help. But at the same time, you can always jet off to the ski resort and turn off your email for a while. So it's a great way to bring back your resources, expertise, wisdom, and network to the community, to give back to them, to be involved with many exciting things that are changing many markets around the world without always having to do legwork that you don't want to. So I know I breezed through this very, very quickly. And there was a lot of asterisks around the nuances of different term sheets and different vehicles. If you would like more information about those specific things and more conversation, you are more than welcome to join us for our webinar series at this link. If you look at swanimpact.org, it's easy to find. You can reach out to me directly. This is my email. Judy and her team can also bring that to you as well. And I'm happy to share this presentation with anyone who would like to have it as a reference guide for perhaps the portfolio structures and some of the risks and terms. So with that, we have 8 minutes left. I'd love to hear if there are any questions, comments, ideas. It has been such a pleasure to have this whirlwind conversation with you so far.
Thank you. Thank you so much, Elizabeth. That was a really fantastic overview, and great to hear about I enjoyed the time you spent on the investment thesis. That's always a really interesting conversation that we have with the investor group at the start of every new fund to try and decide, okay, what is it going to be this year? Is there any special interest? And I see Bert has his hand raised. Bert, please jump in. Oh, sorry, Bert.
Yeah, sorry. The cursor moved when I clicked the unmute. I hate these touchpads. Elizabeth, I'd like to say that was probably one of the best talks I've heard on this subject. It was clear you're obviously enthusiastic about what you do. It resonated with me personally in terms of the goals and the enjoyment and what you want to do. But you covered a lot of topics really quickly, but I'm very impressed. Thank you so much. I think it was a great start for our year of being angel investors. And I personally would like to have a copy of the deck, if I may. And
absolutely. Thank you so much, Bert. That means so much. This is truly, like I said, if you step into the VC world, it's very high stakes, it's very high ego. You don't get that in the angel world. We have so much risk, but we also have so much opportunity. And again, it is fascinating. So I appreciate so much your comments, and we'll be happy to share with you the deck. I hope to see you around the angel investment community later on.
Okay, I'll send you an email so you can send it back to me.
Okay, absolutely, thank you.
Thank you, Bert. And to your point, Bert, Elizabeth did cover a lot. So the purpose of today's session is to really give a global overview on the entirety of the process and why we're here and what it's going to look like once we get involved in investing in these startups. And most of the topics you covered, Elizabeth, then we're going to have separate sessions throughout the next 6 months to actually focus on one of those slides for a couple hours. So that was great. Thanks for the overview.
I'm so glad to hear that. This is, as I mentioned, I put a lot of asterisks out there. I'm so glad you're doing this curriculum. I'm so glad you'll have the ability to have these conversations because there's so much nuance there. And the complexity for that makes it very exciting for me because it means you have more opportunities to take different approaches to help realize businesses that may not otherwise be able to fulfill their goals.
Thanks, Elizabeth. Any other questions from our attendees this morning? Okay, so we'll stop share the screen. I don't know, I think you may have control of that, Elizabeth. Thank you.
Okay.
So again, Elizabeth, thank you so much. We'll share your information with all of our investors. There'll be our more seasoned maybe investors who are participating again will be present at the end of at our next session in October, and we'll send a recording of this one to everyone that's involved in our program. So thank you so much. Any questions from anyone, please email us at angelconference@gmail.com. And we'll be sure to respond to any questions anyone might have. Let's see, Lexi put in the chat a link to the landing page for us. Is it so sorry, Lexi, is that the landing page? And that's the actual portal for the investors, correct?
We have the application and the landing page, but I'm seeing, or the investor portal, but I realized that didn't link, so I'm relinking that one right now.
Thank you so much. So we're going to send the link that goes directly to the application for investors. And also we'll put the link for the portal in case you just want to read up more about what we're doing. The training schedule is also on the slide, and that's on the portal as well. Our next session is October 29th. Again, everyone will receive calendar invites if you have not already, 9 to 11. And this is where we're really focused on what is our thesis going to be this year for Fund 5. And then start looking at big picture, what we want to screen in and out as far as once we start looking at startups. So we'll navigate that conversation. It should be really fun. Really looking forward to it. And if there are no more questions for anyone, have a wonderful weekend, and we'll see you October 29th. Thank you all.